Hi guys, welcome back to my channel. And in this video, I want to talk about how to write a covered call and why I think this is one of the best strategies when it comes to options trading. And I'll also be showing you a live example of how to make the trade online. So I strongly recommend you to stick out through the end of the video. There's going to be a lot of information I'll be covering and there's some details that you don't want to miss. I also think that the covered call strategy works really well right now in today's market. Because in 2023, SP 500 is recovering from some of the losses it had early in the year. But how long is it going to stay that way? Is it going to continue to rally or not? With the inflation, the rise in interest rates, and a lot of layoffs recently, it's hard to say where the market is going to go next. So this is where the covered call comes in. So first, what is a covered call? So let's break it down. The word covered means that it is protected, which means that you already have 100 shares of the underlying stock. By writing a covered call, one contract equals to 100 shares of the underlying stock. So by writing a one contract, you're allowing the other person to purchase your 100 share of stocks at a specific strike price that you determined and a specific time in the future. So what is the incentive for me to write this covered call? It is because the other person is going to pay me a premium or income for writing this option. So it's sort of like renting out your property. Let's say you already own your house, that's your underlying asset, and you want to go ahead and write an option for the other person to purchase it in the future. And at the same time, you're also collecting the rent from the other person for writing this option. So let's go to my screen over here and I'll show you guys how this works. All right, so now we're at the screen here. And I'm using a Robinhood, by the way. I think this is really a great platform for trading options. It's really easy to understand and has these strategies laid out for you. So first you want to go into covered call. And I'm using Apple as an example here. If you don't have Robinhood, you can use this option. You're basically selling a call. Okay, so a couple things I want to cover here. The first, right now, the Apple stock is trading at $181. But also, when you're expiring, let's pick expiration date. I like to pick a month away, but let's just say, for example, let's go with June 23rd. So because that's the third Friday of the month, and that is the most popular option. So when it's at the money is when the strike price is 180, 182.5, when it's closest to 181. When you're in the money is when strike price is below how much it's trading at right now. And when it's out of the money is when your strike price is above. So when you're writing a cover call, you're almost always going to be picking a strike price that is above how much is trading right now. So right now the market is closed, so you'll see some of these are blank. But let's go ahead and choose an option here. For example, let's go with $190. So when I'm picking a strike price, I'm looking at a chance of profit of about 70 to 80% and a delta of about 0.2. So let's take $190 for example here. So I'm basically saying that I'm happy that I'll be selling it on June 23rd for $190. And in return, I'm going to get for 98 cents. But remember, for one contract is equal to 100 shares of Apple. So we have to multiply this by 100. So I'm going to be receiving a $98 income today for writing this covered call. So now if the stock prices of Apple goes up to $190 on June 23rd, which is going to be the best case scenario, because in that case, my stock goes up in value from 181 to 190, and I'm also collecting the premium of $98 for writing one contract of Apple. So your income is going to be $98 plus the gain in the value of the stock from 181 to 190, which is $9 because you own 100 shares. So you'll be gaining $998. So now let's say the price of Apple goes down to $170 on June 23rd. I'll be losing $1,100 on the equity on the stock itself, but I also get to keep the premium, which is the $98. So minus $98. So my total loss is $1,002. But if I hadn't write this covered call, then my net loss would have been $1,100. So in a sense, I'm actually reducing my loss. And at the same time, I get to keep the stock. So when you're doing a covered call, make sure that it is a stock that you want to own 100 shares of and you want to own for a long term, or you already have 100 shares of stock already in your portfolio. So now the third example, which is the worst case scenario, is if the price of the stock goes up to, let's say, $200. So in this case, right now it's trading at $181. Now remember, I have a $190 contract, which means now I have the obligation to sell to the other person at a price of only $190 on June 23rd with a price of $190, which means I missed out on a gain of $10 times 100, which is $1,000. But at the same time, again, I'm keeping the premium, which is the $98 plus the gain from $181 to $190. 190 minus 181 times 100 plus $98. I'm still going to be up $998. So is it worth it? I don't know. Depends. I'm still making money here. What are the chances of this going up this much within a short period of time? You also want to be aware of earnings dates because that's when the stock is very volatile. But at the end of the day, I still made a profit, right? I'm still making $998 within just 20 days. And the thing is, like, a lot of people don't take their gains and they end up selling a loss in the future. But by doing this, I'm taking my gains. And if I continue to write these calls, I'm going to keep getting these premiums. If we do a 30 days contract, then I'll be getting $128. $128 times 12 divided by 18,110. So I'm getting an 8.48% on the premium alone. And Apple stock is one of the stock I'm willing to own 100 shares of. And I'm willing to hold it long term. So it doesn't really matter to me if the stock prices goes down because I know for sure it's going to go up in the future. And at the same time, also able to earn some extra income. So as Warren Buffett said, number one rule is to never lose money. And the number two rule is to never forget rule number one. Because writing cover call, I'm winning no matter what. Unless the price of stock goes down to zero, which I don't think will happen to an Apple stock. So another thing I want to bring your attention to is the implied volatility. Currently for Apple stock, it is at 21%. So now let's take a look at, let's say for example, AMD. For AMD, it is currently at, let me compare apples to apples here. I was at June 30th. And I'm going to pick the strike price at about 80%, should be right here. So the implied volatility for an AMD stock is at 47.88%. But for AMD, you're going to get a higher premium because the volatility is higher. I'll be getting $261 in income for writing one contract of AMD. And you can tell because for $261 times 12 divided by 100 shares of AMD, now your annual income is going to be at 26.7%, which is much higher than when Apple was only at 8.4%, right? But for a stock like AMD, it is because it's more volatile, so that means it can shoot up and it can also go down in value by 10-20% in a month. So you have to kind of weigh your risk and reward. I think Apple is more conservative strategy. but I do also do AMD as well because I get a little higher premium. And now let's just say that you don't have $11,000. There are also stocks like I would recommend is Bank America. Bank America overall, I think is a really conservative stock as well. But for Bank America right now, it's trading only at $28.68. So if you own 100 shares of Bank America, that's only going to cost you $2,868 today. And let's look at a delta of about 0.2 here. That's too much. Okay, let's go with this one. Let's at a strike price of $30. The premium you'll be receiving is $32. So $32 times 12 divided by 2868, which is your investment. So you're getting an annual return of about 13.4%, which is still pretty good. And let's just say it goes to $30 by the time it expires. So 30 minus 28.68 times 100 plus your annual premium. So you're also gaining $164 if the price of the stock goes above $30 by the time June 30th is up. Now, to place the trade, so let's go back to Apple. So to place the trade, you simply go here and you select on sell call, expiration date of June, let's say June 23rd for $190. So I'm happy with this. I'm going to click on this. As you guys can see over here, it also has a chart to show you where your maximum earning is going to be. So at a strike price of $190 and everything below that, you're going to be making that premium of $98. Everything above $190, you'll start to incur a loss, because these loss are the potential gains if the price of the stock goes up significantly. So for this one, I'll go ahead and put one contract here, which is equal to 100 shares. And for the price, I usually like to go with the ask price. Now the reason for that is, so if you go with the bid price, which is 98 cents, usually it gets filled right away. And when you go for the ask price, is $1.03. This will take some time for it to be filled. So at first you might think this is the opposite, like when you're buying your stock. But in this case, since we're selling a call option, so it will be a reverse because we have to buy it back at a later time. So we actually want the value of this contract to go to zero or expire worthless. Or we can also buy it back at a lower price in the future. So what I normally like to do is either put $1.03 here, or sometimes I would go even a little higher than that. And the reasoning behind this is that, for example, when you're about to buy a stock, you're probably not going to be buying at its lowest price. Throughout the day, it might actually drop in value. So I usually like to give myself a little bit of buffer, because I know I'm not going to get the best price at this time when I'm about to place the trade. I don't mind waiting for a better price available. And if it doesn't get filled, it doesn't get filled. I might adjust it tomorrow. But if you want your trade to fill faster, you can also put it in the middle where it's, say, $1. And that should fill much quicker. So once this order is executed, you're going to be receiving that $100. So let's say if the Apple stock falls significantly in 1 week, what's going to happen is that the value of this option is also going to fall down. Okay, so here's an example of a stock that I currently own 100 shares of, which is AMD. So once your cover call is executed, I recommend that you go ahead and create a separate order to go ahead and close out this option. So what you're going to do is you're going to buy to close. We'll go ahead and do this right now. One contract. And for the limit price, so I originally bought this at $380 or $3.80. So I'm going to do 10% of this number because I've already gained the majority of the premium. So what I'm going to do is I'm going to go to limit price here. I'm going to put down 10% of this number. And for the expiration date, I want this good till canceled. Because good for day is only for the same day. So if any time from now till the expiration date, if the value of this contract falls below 0.38, this buy to close order here is going to execute, which means I'm going to be getting $342. So why do I want to do that? It's because I've already gained the majority of my premium, and I don't have to risk my stocks being called away at $123. So yes, this is releasing my obligation to sell 100 shares of AMD at $123. And just double check everything here. We're good. Click done. All right, and down here it will show that this is waiting to be filled. So one of the common questions I got is that, should I do a weekly option or a monthly option? So like, let's say $190, for example. So for this one, you're getting $41 here times 4 in 4 weeks in a month. That'll be $164 versus, let's go 30 days. It's only $128. So yes, if you trade weekly options, it does pay you a little bit more in premium. However, you'll have to trade more frequently. So it basically just gives you more flexibility with what you could do. You can actually close out the option earlier when you go with a monthly expiration date. Whereas on the weekly, you don't really get that option. All right, so just a quick recap here. Writing a covered call allows you to generate some extra income on your existing portfolio or on the stocks you're planning on owning at least 100 shares of. And also recommend looking at SPY as well. It is going to cost a little bit more money, but SPY, which reflects the SP 500, it's going to allow you to do the same thing. And you can also earn a pretty good income as well. And if you gain more shares of stocks, you can actually write more contract, which will allow you to get even more premium. I remember the days when I was younger, I was trading naked puts and naked calls. On some days, I would make a lot of money, but there are also days where I lose a lot of money. You just can't time the market, and the time is against you. Whereas in a covered call, time is on your side. So what I'm focusing on is generating consistent income. So I strongly suggest you guys to use the covered call strategy if you have a bigger portfolio. And even if you have a smaller portfolio, I think you can start with, for example, the Bank of America I mentioned earlier in this video, just trying to get your feet wet. So yeah, I hope this video helped you guys understand covered calls a little bit more. And if you have any questions, go ahead and leave it in the comments down below. And if you guys want me to show you any other option strategies, go ahead and leave it in the comments as well. Other than that, thank you guys so much for watching, and I'll see you guys next time.